So then the question is like, what is my exit path? And I like to use this example here as a way to illustrate the various exit paths in the form of an outcome. It's not common that people know exactly where they're going when they either buy a business or they build a business up from scratch. It's not altogether that common that they know exactly who they're going to sell it to. So quite often the exit path kind of arrives as a form of a journey of awareness of like, oh, the market is telling me that this is the time for me to be looking at selling to a consolidator, or I'm of the age where I need to be thinking about it. And I've been talking to my management team about, maybe someday this could be theirs or your children could be that. So there's kind of an evolution that's been from my experience of what path the business owner will choose to take. So this illustration of this mountain here that I have is really based on what we perceive to be the value that one might get from the various exit paths. And it's been my experience that the highest value in the terms of an exit outcome for businesses that I've worked with is that they would sell their company here to a third party. And that third party could either be a consolidator or even a competitor. But it typically is be some organization that has resources and can fold the business in and achieve some economies, either an overhead reduction or reducing cost of goods because they get better purchasing terms based on the volume, or expand their footprint, get the market share in a greater geography that then allows for maybe some economies in distribution. But the highest value that I've seen is when a business is sold to outsiders. Now, then the other 2 points here that I've got is that this point here could either be an ESOP or a person who's has money and wants just to basically buy themselves a job. But typically I see a higher value in businesses that are sold to an ESOP, but not as high as the value would be if they were to sell to outsiders, is because of the ESOP has greater ability to pay. If it's an S corporation and they go to an ESOP, the ESOP is a qualified retirement plan for those who are not aware. And that qualified retirement plan allows the stock to be held in the ESOP trust and no income tax on those earnings. So if you had, if you had 30 or 40% more money after, your year was done, chances are you'd be able to use that money to buy a more valuable asset. So typically I see a little bit higher range of value on ESOP. It's not a hard and fast rule, but by and large, that's what I've observed in my 20-some years of forming this service for closely held business owners. Then the third is the management team. And selling to the management team could have the same value outcome as the value of in an ESOP, but management tends to have very few in the way of resources available to them to contribute to a purchase price. And if there hasn't been any planning done in advance, then chances are the management would have, maybe 10% of the purchase price available. And that really puts a drag on the availability of funds that could come from the bank to help finance it. So that tends to have downward pressure on value. So what we tend to do in a management transition is achieve the value objective by structuring payment terms, so that the owner is getting a combination of sale proceeds, some ongoing income, and either as a deferred compensation benefit or some form of discretionary expenses that are continuing to be paid by the company, health insurance, continuation, long-term care, automobile, and related costs, some travel. But there's quite a little flexibility in designing plans. Now, over here on the right, I'm showing this parachute, and this is representative of a full exit of a business owner. And typically from my experience, when an owner sells to a third party, there's a desire of the third party to keep the owner on to a certain degree for a little while, but by and large, most of the buyers are looking to get what they need from the seller and then let the seller move on. So the seller basically goes away and then might get 80 or 70% of their purchase price, whatever they sold, their sale value in cash, but yet they can go away and perhaps, and from our perspective, our guidance to our clients is whatever you get in cash at time of closing and sell to a third party, that amount needs to make you financially independent, because the risk of getting paid for the 20 or 30 or whatever the retained interest is there. And those buyers are very smart, and they're very practiced in figuring out ways to get out of paying full value for things, from my experience. Now, that's not always the case, but by and large, our guidance is that you'd want to be able to you want to be financially free. If you sold to a third party, whatever they gave you, that should be enough to make you feel safe. If you sell an ESOP or management team, then you're probably going to be interested in what's going on, because there's going to be a piece of that transaction that perhaps you had to assume as part of a note or some ongoing payment method, either through deferred compensation or consulting agreement, or maybe even you had to retain an ownership interest in it. But you're sitting there, you're watching what's going on in either that ESOP or that management, because you're looking for money to come in that's mailbox money, either through installment payments that are periodically paid, through earnings, or through some form of deferred compensation plan. But at some point in here, at the early stage, there would be some analysis done, probably in the value range. What do any one of these three exit paths look like, and which one of those exit paths is going to solve my problem, or make my goals satisfied, financial goals in that. And that's usually how business owners who have a choice will make their choice, is that, am I going to be okay if I sold to management or an ESOP, or do I really need to go out and find a third party buyer? Because I don't know whether or not my management team is capable of doing it. Because in an ESOP, you're still going to need your management team to be able to run operations, just like you would if you sold to a management outright.